Okay, let's go. All right, yeah. Starting off with the audit risk question here, and the question that we are looking to do is Hart. Yeah, okay, so let's get a Hart go. Let's get a good understanding about this, and let's get started here. Whenever we're doing Hart go, the focus has to be to ensure that we are totally understanding the case and then solving the question. Okay, so starting off here, identify. Okay. So if we first read the question here, what are the question? Firstly, we have to do is benefits of audit planning. What we have to do is explain the benefits of audit planning. That's the first question. Second question is we have to describe 8 audit risks. And also along with that, we have to explain the auditor's response also to each of those risks. Finally, we have to describe some substantive procedures. Okay. The auditor should perform to obtain sufficient and appropriate audit evidence in relation to the director's bonus. Okay. And finally, explain the safeguards which should implement to ensure that that the conflict of interest is appropriately managed. Okay, multiple questions are there. No worries. One by one, we will solve all the questions and we will get moving. Okay. So first, we'll look into the audit planning question as well. See how is planning helpful? How is planning useful? Let's look into that first. So they are told us the benefits of audit planning. What are the benefits of audit planning? So let's get the benefits. So basically we are studying as to why is audit planning important. Okay, why is audit planning important? Why is audit planning important? So ISA 300 is basically the focus here, and we are studying why is it important to do audit planning. Okay, so the keywords first I will highlight, which we have to ensure that we write. Right, the first one is focus. So make sure that the auditors focus more on important areas, right? To focus on important areas. On important areas, you're doing much of the focus is on important areas. Much of your focus is on important areas. Okay, much of your focus is on important areas. Okay, much of your focus is on important areas. That's the first thing. Second, to solve problems early. What you're doing is you're finding issues before they become big. Okay, what you're doing is you're finding the issues before they become big. Okay, helping the auditors to identify and resolve problems on a timely basis. So what you're doing, helping the auditors to identify and resolve issues on a timely basis, right? If you plan better, everything will be done in time. That is one of the biggest benefit of planning, right? Everything is done in time. Second, to ensure that the everything is organized, you run the audit smoothly and on time. Everything is organized, right? Helping the auditor to properly organize and manage the audit, right? You organize and you manage the audit so that everything is done in an effective and efficient manner. So if you are planning well, you will see everything is more organized and managed, and you'll do things in an effective and efficient manner. And finally, right people, pick the right team members who have the right skills for the tasks. Okay, the team that you pick has to be the team that have the appropriate level of capabilities and competence, skills and experience. Okay, skills and experience, you have to pick the team that has the right amount of skills and experience, and if you plan better you can do that. If you plan better you can do that. Finally, directors can direct and review the audit team properly, the control will be better, right? If you plan better, the the direction and supervision of the team will be very good, right? The direction and supervision of the team will be very good. The direction and the supervision of the team will be very good if you're planning. And finally, you can use experts. So what you can do is, if you plan better, you will know that yes, I might need some experts. So you can work with the experts. If you have everything planned in advance, and if you have done a good planning, you will know you will need experts, so you will organize, talk to them, connect with them, do everything on a timely basis. Before itself you will connect with the experts, and you will facilitate the entire transaction and the work that you will do with the experts. So that is all about this. So what is audit planning? Audit planning is addressed by ISA 300, and it said that adequate planning benefits the audit of financial statements in several ways. What it says that adequate planning Okay, adequate planning benefits the audit of financial statements in several ways. Okay, adequate planning benefits the audit of financial statements in several ways. Okay, adequate planning benefits the audit of financial statements in several ways. Okay, adequate planning benefits the audit of financial statements in several ways. That if you plan the audit well, there will many benefits that you will see. So firstly, it's important that you devote attention to important areas, right? Your focus will be good. Second, you will finish things on a timely basis. Third, organizing and management will be good, and you will finish the audit in an efficient and effective manner. You'll have the right people in your team which have appropriate level of capabilities and competence. Next, your direction and supervision will be very good if you plan better. And finally, where applicable, in a coordination of work done by experts. Okay, so wherever applicable, you wherever you need the work of the experts, you can work with them as well. Okay, you can work with the experts as well, and you can work with them as well, and you will see that wherever applicable, if you need the experts help, you can, if you plan better, you will know you need the experts help. You can organize the expert, you can talk to them before only, you can plan everything before only, so that later it's never a problem. Okay, so later it's never a problem. Okay, see that these are the adequate benefits of planning better. So if you plan adequately, these are the benefits that you will get. Okay, let's look into the benefits quickly here. Shukrana, how have you understood the benefits? Yes, yes, yes. Mm.
Proper.
Yes,
And then first, they should direction and supervision of engagement will be there.
yes,
And then we'll be in coordination with expert, work done by experts.
yes, absolutely right. So that is all about the adequate planning benefits and the benefit of that to the entire audit. Okay, so these are all the benefits that you can get if you plan better. Okay, if you plan better, these are all the benefits that you can get. If you plan better, these are all the benefits. So adequate planning will benefit the audit of financial statements in these ways. Okay, adequate planning will benefit the audit of financial statements in these ways. Okay, so if you plan better, you will find that this will be all your benefits. All you have to do is just plan better. And if you're planning better, that's going to be a perfect aspect for you. That if you plan better, you focus on the important areas, work on timely basis, organize everything, have appropriate levels of capabilities and competence, direction, supervision will be good, and finally, the work done by experts. So, these are the benefits of adequate planning. These are all the benefits of audit planning. These are all the benefits of planning. If you're planning well, these are all the benefits that you will face. Next, we'll look into the question B. Here we look into the risk and response, right? Audit risk and response. Let's look into this. The first we'll do is we'll identify the risk. So the identifying the risk is that first of all, you are an audit supervisor and planning of a new client, right? So you are our audit supervisor in a company, an audit firm called MOF, and your client is Hart. Okay, MOF is the name of your audit firm, and Hart is the client, so, her client name. So it's a new client. So that is the first risk. The first risk is the client is new. The first is risk that the client is new. Why is it a risk? Because there is an increased detection risk because the team is your audit team is not familiar with the accounting policies, right? You're not familiar. Also, you are not familiar. That is the biggest risk. Familiar with what? Accounting policies, transactions, and the opening balances. You're not sure if it's going to be correct, right? So this is the main risk, that you're not familiar. So what is the impact of this? This will be an increased detection risk. What is the impact of it? The impact of it that is that the detection risk will be increased. There would be an increased detection risk. What is the impact? Impact is that there's going to be an increased detection risk. What is the impact? Impact is that there's going to be an increased detection risk. Okay, impact is that there's going to be an increased detection risk. So what is the solution? Send an experienced team. Okay, and give adequate time to the audit. Also do increase testing on the opening balance, right? Do increase procedures on the opening balances. Okay, increase procedures on the opening balances. Do increase procedures on the opening balances. Do increased procedures on the opening balances. Okay, do increased procedures on the opening balances. Okay, do increase procedures on the opening balances. Very important. Increase procedures on the opening balances. Okay, so that is about when you have a new client. That is about when you have a new client. So this is the issues. Okay, so what is the risk in green? Why it is a risk? Because not familiar. What is the impact? And then what is the action? Okay, so identify the risk. Explain why it is a risk. Then you have to give the impact, and along with that, you have to give a solution also. Okay, so this is the identifying the risk, the impact, the solution as well. Okay, so that is all about this. Identify the risk. Identify the risk first of all. Why it is a risk, what is the impact of that risk, and what is the response. Okay, so that is all about the audit risk and auditor's response. Okay, so let's look into this. Let's get a good understanding here. Shivashri, how have you understood this quickly?
The first, the risk is there are new clients.
Yes.
So what is the risk is the audit team will not be familiar with their
Yes.
accounting policies.
Yes.
What is the impact is it will increase reduction risk.
Yes.
What is the solution? There should be a expertised team to audit.
Yes.
Then they should do increasing procedures for opening balances of the new client.
Yeah. Opening balances means previous year's closing balance. You have to do an audit procedures on them, and you have to dedicate sufficient time to understand the company, right? Adequate time should be devoted to understanding the company. Okay. So that is all about this. Good job. So that is about the audit risk and the auditor's response. Audit risk, auditor's response, audit risk, auditor's response. Okay. This is all about the audit risk and the auditor's response. Audit risk and the auditor's response. Easy, done. Next, we'll look into, next we'll, as we go in the case. Okay, so the directors are going to be paid a bonus which is based on profit before tax. So whenever there's a bonus that is paid on profit before tax, there's a chance that they will manipulate it. They will manipulate. There's a chance that they will manipulate. There's a chance that they will manipulate. There is a chance that they will manipulate. Director's bonus. Okay, there's a good chance that they will manipulate. Okay, so directors are paid a bonus based on percentage, right? So why is it a risk? Because whenever there's a profit related risk, there's always a risk that they will manipulate and they will try to get maximum bonus. Okay, so why it is risk? That there's a risk that the director will try to overstate the profit, therefore their bonus by increasing the revenue and income and decreasing the expense. This is a particular risk related to judgmental areas. Okay, why is it a risk? Because what the directors will do, they will try to overstate the profit and in their bonus by increase. They will try to increase their bonus. They will try to overstate their bonus. They will try to overstate the profit. And if they overstate the profit, the bonus will also be increased. Right? If they overstate the profit, the bonus will also be increased. Okay. If they overstate the profit, the bonus will also be overstated. Okay. And this can be done by, how can they do this? How will they do this? They will do this by increasing the revenue and decreasing the expenses. They will do so by increasing the revenue and decreasing the expense, right? So what you have to do as a solution, you have to be very alert during the audit. You have to tell the entire audit team to maintain professional skepticism, be alert during the audit to the risk of manipulation, right? Also, adequate time should be allocated to obtain an understanding of the company, right? And the audit team should be made aware of the increases risk of manipulation and should also assigned more experienced audit members, right? More experienced audit members you have to assign more experienced audit members. So firstly, the risk is director's bonus. Why is it a risk? The first of all, what is the risk? Director's bonus. What is the risk? Director's bonus is the risk. Why is it a risk? Because the revenue and income recorded, because why is it a risk is because the directors are getting a bonus based on profit. So what they will try to do, they will try to overstate the profit and they will also try to overstate their bonus. So they should have more profit, and if they have more profit, they will get more bonus. That's why this is a risk. So they will try to manipulate. Okay. So what impact can be happening is that the revenue and income recorded will be increased and the expenses will be decreased. The revenue and income will be increased, the revenue and income will be increased and the expenses will be decreased. Why? So that these guys get a big bonus, right? By increasing the revenue and income recorded and decreasing the expenses and decreasing the expenses. So they will increase the revenue and income and they will decrease the expenses. And what is an action over here? The audit team should be made aware of the increasing risk of manipulation. More experienced audit team should be allocated. Adequate time should be allocated for team members to obtain an understanding of the company. Then the team needs to maintain professional skepticism and be alert to the increasing risk of manipulation. The audit team needs to maintain professional skepticism and they should be alert to the increased risk of manipulation. Okay, the team needs to maintain professional skepticism and they should be alert to the increased risk of manipulation. Okay, they should make sure that they are giving a lot of time to the audit. The firstly, we understood what is the bonus here, what is the issue. First of all, director's bonus. In case of director's bonus, the risk is that the directors will try to manipulate. How? By increasing the revenue and by decreasing the expenses. Why? What will be the impact? They will overstate the profit and they will overstate the bonus also. Okay, and what they should do, the audit team should be made aware of the risk of manipulation. You have to tell your audit team members that there will be a risk of manipulation. Adequate time should be given to understand the company. And finally, the team needs to maintain professional skepticism and be alert. Okay, and they should be alert to the increasing risk of manipulation. That they need to maintain professional skepticism and they need to be alert to the increasing risk of manipulation. Okay, so that is about the director's bonus. So we got the new audit client, we understood, and this is about director's bonus. So what is the risk? We found out why it is a risk, because there might be an increase in revenue and a decrease in expenses. This the team will do. Why will the management do this? And as a result of that, you would see the profit will be overstated and the bonus will be overstated. That's why they'll do it, to overstate it. So what you can do is, again, be more aware, dedicate more time, and you tell the team before only that be ready, there might be some problems here. Be ready, there might be some problems here. Okay, be ready, there might be some problems here. Okay, be ready, there might be some problems here. What you have to do is you have to be ready, as there might be some problems here. Okay, be ready, as there might be some problems here. So you have to make sure that you are ready. Be ready, as there might be some problems. So that is about this. That be ready, as there might be some problems. You have to keep them aware right from the start. That is about this. Moving on now to revenue recognition. So what happens is, customers pay 25% deposit on signing the contract with the balance payable when the control is transferred. So they are giving a 25% deposit. So Hardco is undertaking construction of 16 sites in various locations of the country. They are undertaking constructions, and all playgrounds are constructed to specific customer specifications. Customers pay a 25% deposit. Okay. So the deposit should not be recognized as revenue immediately. Okay. So the risk is revenue recognition is a risk. Okay, what is a risk? Revenue recognition is a risk. Okay, what is a risk? Revenue recognition is a risk, right? And the risk is that revenue will be overstated and current liabilities will be understated. Okay, so what you have to do, first of all, what is the risk? Revenue recognition is the risk. Okay, now coming to why it is a risk. Firstly, we understood what is the risk. Firstly, we understood what is the risk. Okay, so what is the risk? Revenue recognition is a risk. So what is the risk? We understood. Next, why it is a risk? Okay, firstly, what is the risk? We understood. Next, why it is a risk? Okay, why it is a risk? Because the deposit should not be recognized as revenue immediately. You cannot recognize. Instead, they should be recorded as deferred income. Right? Within current liabilities, you have to put it as deferred income until the performance obligation has been satisfied. So they should not record it as a revenue immediately. They should put it in deferred income under current liabilities until the performance obligation is satisfied. Just because 25% they have got upfront doesn't mean they should record it as revenue. Right? If they have recorded it, then your revenue is overstated. If they have recorded it, your revenue is overstated. Okay, discuss with the management the criteria for determining the performance obligation. Next, then you should do increased testing over the cutoff of revenue and completeness of deferred income. Make sure deferred income is correct, make sure revenue is correct. Next, the audit team should obtain a copy of the contract with the customer. Okay, so you take a copy of the contract with the customer and understand the performance obligation. And what you can do is understand the performance obligation. So firstly, it's revenue recognition. What is revenue recognition? That you recognize revenue. What is revenue recognition? You recognize revenue. Okay. So why is it a risk? Our revenue recognition is a risk. It is a risk because the deposit should not be recognized as a revenue immediately. Okay, you should not recognize the deposit as a revenue immediately. It should be recognized as a deferred income under current liabilities until the conditions have been satisfied. There's a risk that the company would have recognized it as a revenue. So what you should do as a solution, obtain a copy of the contracts with customers and understand the performance obligations. Obtain a copy of the contracts with customers and understand the performance obligations. Then you should discuss with the management the criteria for determining whether performance obligations have been satisfied. And finally, during the audit team should undertake increased testing over the cutoff of revenue and the completeness of deferred income. Right? The audit team should undertake increased testing over the cutoff of revenue and completeness of deferred income. Okay, the audit team should undertake increasing testing over the cutoff of revenue and completeness of deferred income. So that is the entire process. So we've understood what is revenue recognition. We understood the deposits should not be recognized as revenue immediately, but you can record it as a deferred income under current liabilities. The revenue should be overstated and current liability should be understated. Then we understood all the actions also, that get a copy of the contract. First of all, understand everything. Second, discuss with the management the criteria for determining the performance obligations. And finally, the audit team should undertake increased testing over the cutoff of revenue and the completeness of deferred income. The audit team should undertake increased testing. What should the audit team do? They should undertake increased testing over the cutoff of revenue and the completeness of deferred income. The audit team should undertake increased testing over the cutoff of revenue and the completeness of deferred income. Okay, over the cutoff of revenue and the completeness of deferred income. The audit team should undertake a lot of testing. The audit team should ensure that they undertake a lot of testing. Yeah, okay, so this is about the revenue recognition. So first of all, what is the risk here? The risk is that they're getting a deposit upfront of 25%. The risk is that they would have recorded it as revenue. They should not. They should record it as a deferred income and current liabilities, because the condition is not satisfied yet. They have got the deposit, but ultimately they have to finish the construction and they have to give them, right? It's not that they've got the money immediately, they can recognize that revenue. No, they have to deliver the building also. So till the time the construction is complete, you cannot recognize that revenue. You should recognize as current liability, deferred income and current liabilities. And what is the impact over here? If you have done it incorrectly, what is the impact? That revenue will be overstated. Unnecessarily, your revenue will be very high. And your current liabilities, where you should have put, that will be understated. So as an auditor, what are the actions that you can do? What are the actions that you can do? Firstly, obtain a contract with the customer and understand the performance obligation. Obtain a contract with the customer and understand the performance obligation. Second, discuss with the management the criteria for determining the performance obligation. Discuss with the management the criteria for determining the performance obligations. And finally, the audit team should undertake increased testing over the cutoff of revenue and the completeness of deferred income. The audit team should undertake increased testing over the cutoff of revenue and the completeness of deferred income. What should the audit team do? They should undertake increased testing. What should the audit team do? The audit team should undertake the increased testing. The audit team should undertake the increased testing over the cutoff of revenue and the completeness of deferred income. The audit team should undertake increased testing over the cutoff of revenue and the completeness of deferred income. This is what the audit team should do. You undertake the increased cutoff testing. Okay, this is about the revenue recognition. All right, let's go through this one, Shukrana. How have we understood this one?
So this should recognized as revenue as it is a contract base. So it should be recognized as deferred income for the any current liability for the current year.
Uh,
And then if at all it is initially recognized as revenue, the impact will be that the revenue will be overstated and current liabilities can be understated. So the auditor's response to this problem should be that they should obtain a copy of contract with the person who has signed the contract and understand how and what is the amount of performance obligation that will be recorded for the current year. And then they should discuss with the management that whether the performance obligations are met or they are not met. If they are not met, they should not recognize it actually. If they are met, only then they can recognize it. And then during the final audit time, the auditor team should take increased testing over the cutoff revenue and then the completeness of deferred income.
okay, good. So this is about this. Moving on now with revenue recognition done. The balance of work in progress in respect of the playgrounds under construction. So how much is the balance of work in progress? 7.6. Work in progress and valuation will be carried out on on at all sites on 30th September. Arrangements have been made to attend all the five work in progress. Okay, to attend all. So arrangements have been made for the audit team to attend only five of the work in progress. See, totally how many are there? Okay, only five they will attend. Okay, so 16 sites are there total now, but they will attend only five. So now there's a problem, right? This is another. The audit team will only attend five of the 16 sites. Okay, five of the 16 sites. Okay, so the risk is audit team will only attend five of the remaining sites. Now, why it is a risk? Okay, now coming to why it is a risk. Okay, why it is a risk? As the audit team is not attending all the sites, right? As the audit team is not attending all the sites, they will be unable to obtain direct evidence. That is why it's a risk. Okay, they will unable to be or they will unable to get all the evidence. So what is the impact of this risk? Detection risk is increased. Detection risk is increased. Okay, so what you should do as an auditor, what you can do as an auditor, okay, as an auditor, what can you do? Okay, as an auditor, what can you do? Okay, the auditor should assess which inventory counts the team will attend. So first of all, you should assess which inventory count you will attend. Okay, try to go to that inventory count where the value of inventory is material. For where you are unable to attain, you look into the documentation and the controls surrounding the counts and review everything. Okay, any exceptions noted during the count, discuss with the management any issues. Okay. So that is about this. So see 16 sites are there. You can go to only five as an auditor. So there's a risk that the where you didn't go, you're not getting a direct evidence. So it will increase your detection risk. So what you can do is first of all decide where you will go, which five you will visit, and the ones you could not visit, obtain the documentation and go through everything. Okay, and any exceptions that are noted during the count, discuss them with the management. Okay, any exceptions and anything you notice, discuss them with the management. That is the auditor's response. Okay, discuss them with the management. That is the auditor's response. We looked into the audit risk, we looked into the auditor's response. Looked into the audit risk, we looked into the auditor's response. So that is about the audit risk and the auditor's response. The audit risk is work in progress. Why? Because you can only attend 5 out of 16. So where you did not attend, there you will not get direct evidence. So what you should do? First of all, decide which file you will go. Second, wherever you need to obtain the review of the document, wherever look into the need to obtain a review of the documentation relating to the controls and any exceptions noted during the count. Discuss with the management any issues which would arise during the count. Discuss with the management any issues that would arise during the count. Discuss with the management any issues that would arise during the count. Discuss with the management any issues that would arise during the count. Okay, discuss with the management any issues that would arise during the count. Okay, discuss with the management any issues that would arise during the count. Okay, that is about this. So that is about this. Let's go through this one. Yeah, Shivashri, how have we understood this?
So the risk is they are only taking, they are only looking into the five sites where they should look for 16 sites.
Mhm.
So why it is a risk means because they, if they are seeing only the five, they will not be able to obtain the direct evidence of the remaining sites. So the impact is there will be a deduction risk. The reduction risk will be increased.
Okay.
So what should the auditor do is the auditor should see which five sites he should choose. Then he should obtain and revise the documentation of the remaining sites. And if there is any exemptions noted, he should discuss with the management.
Okay. If there's any exemption noticed, what you have to do is discuss it with the management if there are any exemptions. That is very important. Okay, so that is about your work in progress. Good job. That is about your work in progress.
Excellent.
All right, moving on to the next one, yeah. Warranty provision. What about the warranty provision? So let's look into the warranty provision here. Okay, so looking into warranty provision, everything that we can pick from the warranty provision here. Okay. The warranty provision for the current year has been calculated as 2% of revenue. In the previous year, the warranty was 6%, right? Previous year it was 6%. Now it has become 2%. The finance sector has made this change despite no significant difference in construction techniques or the level of claim. Nothing has changed. Simply he has changed from 2 to 6. Why? There should be some basis to change, right? Simply you cannot change from 2 to 6. So first as an audit team, you should discuss that why did you change it, right? First you have to discuss why did you change, that what was the basis for you to change, right? And then compare it to the industry average also. What is the industry average? Okay. Compare it to the prior year provision with the actual level of claims in the year, right? Like how many people actually claimed warranty to assess the reasonableness of the judgment. Previous year, not this year. This year, no. Previous year, you actually see how many people claimed for the warranty. How many people actually claimed for the warranty. Previous year, see how many people actually claimed for the warranty. Okay. How many people actually claimed for the warranty? Simply, you can't change from 2 to 6. Okay. Maybe this has been done for the bonus also, right? Because they are reducing the expense, right? So it could have been done, but again, why have you done it, right? There's no extra cost, there's nothing improvement, nothing has happened, and why have the increase? Why is the here 2%? It was there. Calculate 2% of revenue. Previous year it was 6. Currently, you have done it to 2. Why? Right? Despite no changes have happened, why have you done that? Okay. Okay. So under IS 37, this should be recognized as a warranty provision. Calculating warranty requires judgment as it is an uncertain amount. Okay. The provision is calculated as 2%. In the previous, it was 6%, despite there being no changes. Right? Warranty provision is because since this is, even though there are no changes, still you have reduced it from 6 to 2. Why? There's no reason to do it. Right? So there's a risk that provisions could be understated, leading to understated expenses and liabilities. Liability understate, warranty expense understate, and provisions could be understated, expenses could be understated, liabilities could be understated, multiple things could be understated here, because there's no reason to make the change. Why have you reduced from 6% to 2%, right? For no good reason you have reduced it. From no good reason you have reduced from 6% to 2%. What was your reason for reducing? Okay, what was your reason for reducing? What was your reason for reducing? Why have we reduced from 2% to 6%? Okay, what was the reason for reducing? So that is the problem again. What was the reason? Why did we reduce? No good reason. Okay, no good reason why the reduction happened. Okay, no good reason why the reduction happened. No good reason. Okay, no good reason why the reduction happened. Okay, there was no good reason why the reduction took place. Next, has incurred a research cost 1.8 million research cost. 0.6 to the date has been written off to P&L. The remaining has been capitalized. So see, research cost should never be capitalized. Research cost should always be expensed, right? Research cost should always be expensed. You should never capitalize the research cost. Okay, research cost should never be capitalized. They have capitalized research cost. It's always only expensed in P&L. There's no reason to capitalize. So here it can be the intangible assets are overstated, research expenses understated. Because why? Because you have capitalized the research cost. You should never capitalize the research cost. Okay. So this is a incorrect application of an accounting. The audit team should obtain a breakdown of the research cost, right, and see everything that is capitalized. Any development expenditure should be agreed as meeting the criteria set forth in as per IS 38. The team should also discuss the accounting treatment with the finance director and ensure it is in accordance with IS 38, right? It should also see if it's in accordance with IS 38. Okay, the audit team should obtain a breakdown of the research and expenditure recognized in the profit and loss and the development cost that is capitalized. Any development expenditure should then be agreed as meeting the relevant criteria. The team should also discuss the accounting treatment with the finance director and ensure it is in accordance with IS 38. The team should also discuss the accounting treatment with the finance director and ensure it is in accordance with IS 38. Okay, so what should the audit team do? It should obtain a breakdown of the research expenditure recognized in profit and loss and of the development cost capitalized. Any development expenditure should be agreed as meeting the relevant criteria. The team should also discuss the accounting treatment with the finance director and ensure it is in accordance with IAS 38. Okay. Also, you should discuss the accounting treatment with the finance director and ensure it is in accordance with IAS 38. Right. So first of all, any development expenditure, any research expenditure should never be capitalized. Any research expenditure should never be capitalized. Why are we capitalizing research expenditure? Right. There's a risk that the requirements of the standard has been wrongly applied. What is the risk? That you have wrongly applied the standards criteria. Whatever the standard says, you have very wrongly applied it. Whatever the standard says, you have wrongly applied it. Right? That the requirements have been not been applied correctly. There's a risk that the requirements have not been applied correctly. What is the risk? That the requirements have not been applied correctly? What are the requirements? There's the risk. The risk is that the requirements have not been applied correctly. Okay. What is the risk? That the requirements have not been applied correctly. The audit team should obtain a breakdown of the research expenditure recognized in profit and loss and the development cost capitalized. Any development expenditure should then be agreed as meeting the criteria. And you should also discuss the accounting treatment with the finance director and ensure it is in accordance with IAS 38. You have to ensure that it is in accordance with IAS 38. It is in accordance with IAS 38. What we should ensure that it is in accordance with IAS 38. What we have to ensure that it is in, we have to ensure it is in alignment with IAS 38. That is the auditor's response. So we got the research and development and we got the auditor's response. Moving on now to PPE, property, plant and equipment. In June, the company contracted to purchase a new property, a new machinery for 2.4 million. It paid 1 million on signing the contract to secure the machinery, which will be delivered in July. In June, they signed it and they paid 1 million, but it will be delivered in July. Due to a supplier problem, the delivery is now delayed also, and it was now scheduled to be delivered in October. Okay. It will now be scheduled in October. So basically, why is it a risk over here? That only assets which physically exist should be classified as property, plant, and equipment. The 1 million deposit paid in advance should be recognized as a prepayment. See, now the asset has not come, so you don't count that. Just because you have paid 1 million doesn't mean that we should count it as your assets, right? You cannot count it as your asset because the delivery has not yet happened. Okay. So the deposit of 1 million paid in advance has been capitalized and prepayments are understated and PPE will be overstated, right? The 1 million, the PPE, you have to call it as a prepayment, right? If the deposit of 1 million paid in advance has been capitalized within PPE, prepayments are understated and PPE will be overstated. Okay, what happens? The prepayments are understated and the PPE will be overstated. Prepayments are understated and the PPE will be overstated. So what you have to do, review the non-current asset register to determine if the 1 million paid in advance has been capitalized. Okay, whatever you have paid in advance, has it been capitalized? That's the first thing. Review the non-current asset register to determine if the 1 million paid in advance has it been capitalized. Whatever 1 million that you have paid in as advance, has it been capitalized? Okay, the 1 million paid in advance, has it been capitalized? First thing, review the non-current asset to determine if the 1 million that is paid in advance has been capitalized. Discuss the correct accounting treatment. You cannot capitalize it. Discuss the correct treatment with the management. Okay, to confirm that the amount capitalized has been recognized as a prepayment, right? To confirm that the amount paid in advance is recognized as a prepayment and if it is incorrectly reviewed. So first of all, discuss the accounting treatment to management to confirm that the amount paid should be recognized as prepayment. See, whatever 1 million you have paid, it should be a prepayment. Okay. Then review the non-current to determine if the 1 million paid in advance has been capitalized. So what you have to do is, though you will get you have paid 1 million, right? See, the asset was 2.4, you paid 1 million and you will get it in advance. The asset was 2.4, you paid 1 million. Okay. The asset was of 2.4 million, you paid off 1 million. Right now you paid 1 million. And but now the delivery has not happened. So only assets that physically exist at the year end should be capitalized. The 1 million you should not capitalize, you should record it as a prepayment. But the risk is that they would have capitalized it. And if they would have capitalized it, then your PPA will be overstated and the prepayments which should have been the right treatment, that would be understated. So what you have to do is you should review the non-current asset register to determine if the 1 million paid in advance has been capitalized. What you do is review the non-current non-current asset register to determine if the 1 million paid in advance has been capitalized. Also, what you should do is discuss the correct accounting treatment with the management to confirm that the amount paid is recognized as a prepayment. Also, what you should do is confirm that the amount that is paid in advance is recognized as a prepayment. Also confirm that the amount that is paid in advance is recognized as a prepayment. Okay. The amount paid in advance is recognized as a prepayment. Okay. The amount that is paid in advance as a recognized in prepayment. Okay. That is about this. The amount that is paid in advance is recognized as a prepayment. So, if though you've paid 1 million for something that costed 2.4 million, you cannot record it as your PPE. You only when the assets is physically delivered, you can record it as PPE. So that 1 million should be recorded as prepayment. But if you've recorded as PPE, then your PPE will be overstated, your prepayment will be understated. What you should do is discuss with the management, also review the non-current asset register to ensure it has not been paid as PPE. Right? Review the non-current asset register, discuss with the management also and confirm if the amount has been recognized as a prepayment and confirm if the amount has been recognized as a prepayment. So that is all about this. Okay, let's go through this one. Shukrana, how have you understood this PP?
So the PP is taken, like the PP is still not delivered to the company.
Yes.
And my PP is costing 2.4 million
Hmm.
and the company has already paid
Yes. Hmm.
asset which is physically present.
Yes.
So PP is not present.
Yes. Yes. Hmm. Sure. Okay. Okay. Shivashi, are you following? Is it feeling easy? Are you able to keep a track?
Yes, sir.
Okay. Good. Good job. Okay.